Welcome back, everyone, to another episode of Cash Flow Positive. I'm your host, Kenny Bedwell, and we're going to be talking about a deal finding metric that you most likely aren't calculating when you're trying to find a good deal, a good opportunity. We're going to be talking about this metric in detail, why it's important, especially in 2026 as times are adjusting and changing. We're seeing the stabilization of the short-term rental market over the last 3 to 4 years, and how you should prepare, and you need to be thinking about deal finding in the future. I promise that if you listen to this entire episode, you're going to take some nuggets away from this that will help you clearly understand and better define what a good deal looks like in 2026. So let's dive into it. For those of you who are new, who are watching, welcome. Love new listeners, love feedback. And if you could do me a favor, if you find any value from this episode, please like and subscribe if you're watching on YouTube or another channel. And then more importantly, would love to hear your feedback. Leave a review, preferably 5 stars, and let me know what you think of the show. I love reading the reviews, and also you're welcome to reach out to me on social media at Kenny_Bedwell and tell me your thoughts, or if you have any ideas or any topics you'd like me to talk about. All right, let's dive into it today. So we need to be able to determine ARV. So ARV stands for after repair value. Okay. One of the biggest things that I talk about on the show, obviously, is cash flow. How do we make properties cash flow? But the number one mistake I'm seeing, and I'm going to break down a deal for you that is so common these days, and it's embarrassing, for me at least. It's so difficult for people to understand because they focus so much. We've been trained so much on cash flow or gross revenue, which isn't even cash flow, but cash flow will say that people forget the one of the most important metrics in actually how you build wealth in short-term rentals, which is after repair value or just forced appreciation. Everybody wants I hear this all the time. They're like, well, yeah, I want my property to appreciate. But appreciation historically, if you look at a 30-year period of time, is between 3 to 5% in most markets. Okay. Now, obviously, with COVID, we saw a massive bump, but that's not going to happen anytime soon, according to I've got my little crystal ball over here, my crystal ball, but no one really knows the future. So you can't go hunting around for properties in quote unquote markets that are better, like that are higher appreciation, and sacrifice cash flow at the same time. So it's like this trade-off. So for example, I see some people buying in, they buy West Coast. Like San Diego is a very, very good example of this. San Diego has historically had some of the better appreciation rates, slowing down a little bit though, but historically had some great appreciation. None of the properties there cash flow. Okay. They have some strict regulations, but you can still STR there. But the properties are too expensive given the revenue to purchase price ratio. Okay. So they don't cash flow, but they appreciate very quickly. So it's really a buy and hold game there, right? This goes back to your goals. Why are you trying to buy the property? What's the whole point? But at the same time, on the flip side, and let's go over the deal together that I recently heard about online. That was just wild to me. People are buying properties and they're overspending on amenities. They're overspending on improvements to the property to force cash flow higher, but not force appreciation. Okay. And I see that one a lot more common than unfortunately, the first one, where people are going into markets like, a Destin, Florida, for example, or a Lake Tahoe, or, these vacation rental markets that are appreciating, but they're not cash flowing. That one I don't, and I spend a lot of time on. They're a little more obvious. Obviously, people are like, well, I want it to cash flow, but we're not calculating ARV. So the deal that was recently posted online, I saw in a group, and some of you saw this one too, and you'll know exactly what I'm talking about. An individual, and I'm not going to say the name, I'm not going to say the market. It doesn't really matter for what I'm going to explain, but it's just crazy, the thought process here. It's an individual, I'm going to say this part, they were suckered into buying a property that really wasn't that special. The only thing special about it was that it had potential to increase the bedroom count. Okay, so it was a 4-bedroom. They bought it for like I'll use 600,000 in this example. And they were told, well, if you improve the bedroom count and you dump a lot of money into it, you can force appreciation or get that money back. That's what they were literally told. Not force appreciation, not those terms, but get your money back. So the realtor sold them this property on the hopes that if they did all this crazy design, they spent all this money on this property, they could get it back through a refinance. Because this realtor had some success with the past in some of the other properties doing the exact same thing. The problem, though, is the investor doesn't understand, number one, that all properties are not the same. So if it works in if it works in one area, it's not guaranteed to work in a different part of that market, in a different neighborhood or different zip code, right? Because short-term rentals are still valued on residential real estate. So the thinking was, okay, I can just increase bedroom count, and that will get me a higher valuation of this property. However, that property lacked much of any other key variables that would increase value. It was in a mountain market and had zero mountain views. It didn't have a swimming pool. They didn't add a swimming pool. What did they do? They added an insane amount. They paid one of the best and most expensive designers in our space to go in. They overspent on design, decor, and amenities. And there are diminishing returns for every extra dollar you put into design and decor at a certain level, right? And that level will vary property to property. But the reality is they spent over, get this number, $450,000 into this property. So all in, including the purchase price and the design decor amenities, they were all in at like almost $1 million. They got some like credits or whatever to off, but it was like at $1 million. All right. All in at $1 million. And the thought process was, is this property as a 6-bedroom would appraise for well over $1 million. They could pull all their money out, and they called it a BRRRR. Okay. Number one, it appraised. They got it. They tried to reappraise it and appraised for like $850. A huge miss out the gate. Okay. Number two, so let's talk about the revenue, because they are running this property. This has been going on for almost a year. They've had it for almost a year. So they are going to do about $210,000. Okay. On the books, they had 175. Given what they had available left over, I did some math and averages. It's going to be about 210, maybe 215 best case scenario, right? Which isn't bad on a $600,000 purchase. That's actually pretty good, right? Okay. But remember, value is at $850. So their logic, so they look at the gross revenue and they run their numbers based on their expenses, which you have very low debt service here. So your revenue is actually going to be your net revenue is going to be really high. And they ran it was like $60,000 a year. So net $60,000 a year. So they're coming on and they're saying, I did a BRRRR, okay, which this is not a BRRRR, which is buy, rehab, refinance, rent, repeat. It's not a BRRRR, all right, because they didn't run the numbers correct. I mean, it's a bad BRRRR if you want to call it that, but they're calling it a BRRRR. Look at my cash flow. Look at my gross revenue numbers, right? And here's the crazy thing. In the comment section, people are celebrating it. Lenders are celebrating it. Realtors are celebrating it. Gurus are celebrating it. Because they're all focused on it's really one metric, which is the cash flow, but the gross revenue is really high given the purchase price. Okay. That's fair. However, as savvy real estate investors, we know better. When I saw that and I was looking at the numbers, I was like, that's a pretty average deal. I mean, people were like, wow, that's incredible. That's amazing. You're making all this money. But when you think about it, how much he or she spent into the property, $450,000 into the property, and you're only netting 60, maybe 70K. Obviously the expenses can vary based on, what you have to do to it, but capital expenditures and improvements as things break down, but throughout the year. But the reality is you divide that together and it's actually an average return, below average return in my experience. It's not that special. It's like a close to 15% return for $450,000, not including the down payment. And so although you're getting this great cash flow number that we've all kind of idolized, this, I got to make over $50,000 a year on a property, you overspent and did way too much to get to that point. It isn't a good deal at all. It's actually an average to poor deal, in my opinion. And what makes it a poor deal? So average deal, it's obviously great, the cash flow, but the return, the ROI perspective is bad. Not bad, but just like whatever, 15%. Okay. That's probably like market standard today for people who know how, like, who are actually looking for good deals, not just buying anything. However, the cost to spend that, you could have done multiple deals with the same amount of capital and gotten two properties that are giving you the exact same results, but are now worth more. And when I say worth more, meaning you could have gotten your money back and done a true BRRRR or a true renovation with that much capital. So what makes it a poor deal is that the ARV, the after repair value, was only an increase of $150,000. Okay. Now, this is an example. These aren't the exact numbers I'm giving you. I'm actually, they bought it for a little bit more than 600, but it's just easier to 600 and 850 and like all this stuff. It's a little bit worse than what the actual deal itself. The numbers are a little bit worse than what I'm telling you. But even from this standpoint, it's a poor deal because you have so much cash into this deal. You're going to have to hold on to it or you're going to lose if you have to sell in the next three. Remember, 850, you sell at 850, you still have to pay fees and everything, realtor fees, closing fee. That's 10%, right? So you're going to lose close to $85,000 off of fees and other garbage. So in reality, that's a year of cash flow plus you're positive 150, meaning you spent close to $1 million altogether with the purchase price. And they didn't buy this all cash, they did a loan. But when we're looking at these deals, we're looking at it as if you were to do cash. So you're $1 million all in kind of thing. That's what you got to think about at 850. So you're 150 difference. Plus you had to sell it. That's 8. So that's 4 years just to break even on a deal, right? Like to cover your like initial, try to cover if you were trying to get out. Okay. That's not actual cash flow that you're making for that particular, and that's not to get your money back. That's literally to walk away net neutral, right? So that's not a 4-year return. The yearly return is 60 or 70,000, whatever your cash flow is, divided by how much capital you put in, which is, if they did 10% down, so it's 600, so 60,000 plus 450. So you're all in at 510. So 65, that's terrible. That's like 11%. Plus you have zero appreciation, like true value to make up what you invested in the property. So the ARV is one of the most important metrics we need to be focusing on. The biggest mistake I saw investors make in 2025 was dump tons of money into these properties and they don't have it back in value. Meaning if they had to sell, they would lose money, even though the property, quote unquote, cash flows. Okay, that's great and all, but your only hope, your only play is the cash flow. And when things inevitably happen, like hurricanes or earthquakes or fires or sickness or whatever, and your market gets shut down, you are in trouble. So what I want you guys to understand, and my goal for 2026 is to really beat the drum of the ARV. We want cash flow. Yes, obviously that's how we get a good return, but the good return also should be coupled with forced appreciation. Okay. If you're going to go into a deal and you're going to put quote unquote $1 million all in, even though you take a loan on the 600 or whatever, okay, the property should be worth at least $1 million when you're done with it, right? If not more, hopefully more. And that's the kind of stuff we're looking for. Okay. So I'm going to be frank with you. Not every deal that I've done is, oh, wow, I've got a spread of, $200,000, $300,000, $400,000. Okay. That's not every deal. So the 4 deals that I've done in the last year and a half, not the hotel is strictly a forced appreciation play. The 4 deals I've done. So one of them is with the amount of capital we invested into them, it's worth what we've pretty much the total amount we've invested in plus the purchase price. That's it pretty much. Maybe we could get a little bit more out of it, especially with some of the rent numbers we're pulling, selling it to another STR investor. But if we had to sell it on the residential market today, okay, we did increase bedroom count. We did add a bathroom, which improves value, but we also spent $350,000 into the property. Okay, we bought it at $975. and it's maybe worth 1.4, 1.5, 1.5 on a good day, 1.4 realistically. Okay. Now, is that a bad deal? No, it's not. It's not a bad deal. But when we think of the ARV, it's really just a net neutral, right? We didn't really force that much appreciation to cover the expenses of the actual deal itself. Now, fast forward today, that one was actually not, we launched at the beginning of last year, but we really got in 2024. As I've learned, and I'm learning with you guys too. I'm growing, I'm developed. Like this is a journey that we're all on. And for those of you who've been listening for a while, hopefully you've seen that progress that I have personally made as well. And my goal is to share that with you on these podcast episodes and the lessons I've learned, the experiences I've gone through, so that you can expedite your learning and growing process as well. And so, in 2024, it was all about cash flow. And this same property that I'm talking about, it grosses close to $230,000 a year. So when you think about that, 975 purchase price, gross is 230 a year. We're going to net 7,500K on this property. It's not that bad, right? That's a great cash flow play. But the appreciation, it's a net neutral. Now, the good news is if we sold it, we could sell it and we've made money from it, from the cash flow. So we could walk away with all of our money back plus the cash flow we've got, right? So that's not bad. We would actually walk away with 100 grand theoretically if we walked away today. Okay. However, fast forward to last year in the more recent purchases we've done, we focused really on getting the forced appreciation and the cash flow, right? We know the formula to finding cash flowing deals. And we know that we have the capital to invest in the properties and the amenities and the design and improvements to the property to get the cash flow. But we also understand the value of appreciation and forcing appreciation. So what I mean by this is we bought a property, okay, that somebody was a relative had passed away. This person inherited the property and they were trying to get rid of it. Okay. It's a good property, good location. And we bought it for 1.3 million. All right. Now it appraised. We were able to, so we went through the whole, we did a loan and it appraised for 1.6 million. So we have instant equity of $300,000 without having to do anything to the property. That's a huge win, number one. Okay. And this happens. Okay. And it can happen at lower purchase prices too, but it's not going to be a $300,000 spread, even though I have seen that happen before, but that's another story. So $300,000 spread, 1.3, 1.6. So we're already at a positive gain, right? But we're planning on rolling into this thing and spending $450,000. Okay. So what are we focusing on to improve the after repair value besides adding really cool amenities, which don't improve, really realistically don't improve repair value, design and decor, which don't improve repair value theoretically? We're going in and adding bedrooms, legal bedrooms, okay? Not just, this is an office or a bonus room, and throwing in beds and it's going to improve value. It has to be a legal bedroom, closet, egress window, and maybe any other restrictions that your municipality might have for that area. It's usually what it is, though. Heating, cooling, obviously, and bathrooms, right? And then also maybe making other improvements, capital improvements to the property. So improving the structure itself, or adding a pool or other fixed amenities that can actually really, really improve value and make this a cool space. So what do we do this one? It had an ADU with a 2-bedroom, 1-bath that wasn't technically a legal 2-bedroom, 1-bath, and they couldn't sell it as such. So we made that a legal 2-bedroom, 1-bath in the ADU. And then obviously updated some of the property. The really nice part was it was relatively new, it was relatively updated. So we didn't have to update the kitchens. We didn't have to update the bathrooms. We added a few bathrooms and a half bath and some bedrooms to make it go from a 6 to a 10 overall. And with the 2 additional bedrooms in the ADU that gave it to the 10-bedroom, 1-bath that are now legal on a legal septic system. Okay. So we're like figuring all these pieces. Okay. So now that property reappraised for 2.3 million. What was our buy price? 1.3. Okay. We put $450,000 into this property and it reappraised for 2.3 million. Now I have the option to pull that money out or leave it in and take advantage of the cash flow, which is what we're going to do. Okay. Now, if I could pull the amount of money this property is generating, okay, it's going to do, so it's already been launched. We're already rolling and we're in about 4 months now. And we're on target. We think we're going to do between $350,000 and $400,000 in year one on this property. Okay. Remember, $1.3 million purchase price. So we're going to cash flow an insane amount. Now, if we refinance and we do like a cash out to get all of our money back to deploy into other assets, okay, now we're going to be at a $2.3 million valuation, right? With, taking 20% or 25, leaving 20 to 25% back for the cash out refi. So we're getting all that money that we put in back into the deal and then some to deploy into other potential deals if we decide to. But our cash flow will go down because we have a higher debt service because we did a cash out refi and increased the loan amount. So we don't really want to do that. We don't need the money back to do other deals. We have other money that's set aside and other potential partners. And so my point being is like that the journey splits there of the options you can do, right? So I have three things I can do. Number one, I can leave it and let it cash flow. All right. And just hold on to the property. Number two, if something were to happen and that market were to be shut down for whatever reason and it just property stopped making money, we could sell it on the residential real estate market. And theoretically, we could get all of our money back and then some, theoretically, assuming someone's going to buy it at that 2 point. That's another assumption that we're assuming because of the appraised value. But even if it didn't, even if we sold it for 2 million, we're still positive. Even if we sold it for what was it? We put 450, so 1.75, we're still positive. So that's how you have to think about it, right? So that's the second exit strategy. And the third exit strategy is you just do a refinance. You cash out refi, you take on higher debt, drops your cash flow down a little bit, and you redeploy those funds into other potential deals to scale and to grow. So I have three options. Whereas this other person who sunk the same amount of money into a property that was obviously a cheaper purchase price only has one option because the property isn't worth that much more. Okay. Without losing money, one option without losing any money, which is to buy and hold and let it cash flow in hope that there's nothing that happens, that nothing changes. There's nothing that impacts that market or potentially changes or impacts the cash flow that property is generating. Okay. Do you see the risk factor there? Praying and hoping that all things, 450,000. So it's like over $500,000 in hopes of one thing happening, continuing to happen versus having the option of three things that you could do, right? I choose the three all day, every day, including Sunday. So I want you to, when you're looking at deals and you're approaching this, and I haven't really gotten into, how do you calculate ARV? How do you find deals that have good ARV and all this? And I guess I could spend some time on that. Talk for however long I want. Or maybe I'll do another episode. We'll see. We'll see how I'm feeling. I mean, realistically, like what I want you to do is I really need you to understand in 2026, when you're looking for opportunities, when you're looking for deals, to keep the ARV in the back of your head. Stop trying to buy at the top of the market. Okay. I have told you guys time and time again that we have to be willing to invest into our properties. Okay. And if you don't have $450,000, which most of you don't, to invest, okay, then you don't need to be buying $1 million properties. That's simple. Go down in purchase price. There's nothing wrong with that, right? If I had $200,000, I'm looking in the 500 to 750 range. Now I'm king of the hill with that because you're competing against people who have lower budgets, who aren't thinking about the stuff that we're talking about. So understand your budget and how you can be king of the hill and where you could be. It's not necessarily, well, I can afford more. Awesome. That doesn't matter. What matters is the cash you have on hand to invest into the property, right? You can take a $600,000 property. We did have somebody take a $685,000 property and is now worth $1.2 million from the renovations and updates they've made into the property. You can find those deals. You can find those opportunities in the right markets. And typically those markets, and this ties into how do we do that, Kenny? Typically, we're looking for opportunities and deals where there is a spread in the market, meaning there's $1 million homes with $500,000 homes next door, right? So let's take some examples. Traditional vacation markets or old school vacation markets. And when I say traditional or old school, that doesn't necessarily mean they're markets that everybody knows about. You know, the one that was 685, that was 1.2, worth 1.2. That's in Hunter, New York. But that's a ski market that's been around for decades, right? But you can do this in other markets. I think it's Sedona, where that's a higher budget, that's a higher purchase price. You're gonna be playing in the millions. Okay, you are gonna have to have higher amounts of cash. But my point being is like you can do this in very popular markets. You can do this in quote unquote less popular markets that people aren't talking about, but that are traditional vacation markets where there's a spread. We're looking for those. Wow, here's a property for 600,000, and next door there's $1 million property. Now, obviously, if the $1 million property is like this 15-bedroom and yours is a 2-bedroom, you're not going to get that that spread. What I'm saying is, the first thing that I look for to really capitalize on ARV are markets where I'm not buying at the top of the market, right? I'll give you an example. If I'm going to buy in a market where everything's $500,000, I shouldn't be buying at $500,000. I should be buying at 400 or 350 or 300, right? To get that spread. Okay. Obviously, I don't want to be buying in a market where everything's $500,000, even if you don't have the budget, right? If you can only afford something at $350,000, I'm still looking in markets. Sure, there's got to be $350,000 properties there, but there are properties there that are maybe worth 700, maybe worth 600. I think of a really good example of this is Luray, Virginia, right? Shenandoah area. There are properties there that people are selling for $1 million, right? But then there are properties there that people are selling for $300,000. I like the spread. You got to look for markets that have the spread. Not every market has it. Okay. A lot of markets have grossly appreciated, and that's forced everything up. And so even the crappy ones are still overly expensive, right? And there's not much of a spread there, meaning everything's at $1 million and the dumpy house is 900,000. Well, there's $100,000 spread there, but you're going to have to put a whole lot more work into it to try to get the value up. And it's already potentially at the ceiling. Now, I understand an element of this is learning how to negotiate and work deals down, but there's tremendous opportunity in some of these markets, even national park markets as well, like big. So think ski markets. It's really vacation markets. Beach markets, you could potentially do this in. I think there's too many eyes on the beach markets, in my opinion. I really like the mountain markets for this kind of deal. Not the remote ones, but the ones that are like the more popular, the ones with ski resorts, with like some of the bougie houses out there. That's where you can find some really, really good spreads. And that's what you're looking for. You're looking for an area where you can buy low and force appreciation and get cash flow at the same time, which is, frankly, a lot easier said than done. So maybe on the next episode or some episode in the future, I'll talk more about this, like how to find deals with using ARV, how to calculate ARV and run that in a pro forma. But you got to start thinking about it. Think of this episode as the intro to it, open your eyes and help you realize, hey, I need to be thinking about ARV more than ever, forcing appreciation and getting that value, and which gives me more options in the future. That's really what it's about, right? You don't know what the future holds, right? We got our magic crystal ball here. We don't know what the future holds. Okay. We don't know if good things or bad things are going to happen. And so if that's the case, we have to hedge against that by finding real estate deals, being a savvy real estate investor that finds real estate deals where you have that appreciation in your back pocket, okay? Or you've already taken advantage of it and leveled up into other types of deals and diversified your portfolio, okay? So hedging is all about having options and taking advantage of properties where you can cash flow and appreciate. Now, I hope you've enjoyed this episode. I hope it helps you think about how you buy real estate and your strategies and what you need to do. Remember, first and foremost, you are a real estate investor, not just an STR marketer or operator. That's next. That's obviously next in the journey. But the first thing is you have to buy correctly, buy good real estate deals. If you do that, your likelihood of success is extremely high. And the likelihood of failure is incredibly low because you bought right. That gives you options to do very simple things. I'll wrap up with this. I'll say this. I was having a really interesting call with Rachel, who's been on the show before, one of our consultants at STR Insights. And she said, Kenny, because she's going to sell one of her properties. And I was like looking at, she's like, look, I don't even do, she's like, I use Airbnb smart pricing. I was like, Rachel, like, what? She's like, yeah, I don't even care. I'm like, you're leaving money on the table. And she goes, oh, I know. But I want to buy real estate deals so good that it doesn't matter how well or how poorly I operate, they still make money. Right. That's the dream. That's the vision. That's what I want you guys to aspire. Now, that doesn't mean I don't want you to use smart price, like, or revenue managers and price labs and all that good stuff. But my point being is be smart about how you buy so that makes you more comfortable on how you operate. I hope you enjoyed this episode. And I forgot to mention, if you're new to this or you've already heard and you need a little push towards, if you're considering coming to the STR Scale Summit in New Orleans, February 27th to March 1st, this is your nudge. This is your push. Go to the strscalesummit.com and buy your tickets now. We still have about a month, a little over a month. Actually, it's coming up on a month before the event. I'm super excited. We're going to talk all about scaling and how to grow your portfolio. And it's going to be a very special event where it's not just shut up and listen from this somebody speaking on stage. We're going to have workshops and be breaking it down for you intimately and talking about different commercial assets and how you can scale into larger short-term rentals, boutique hotels, micro resorts, and other commercial assets out there. And I'm going to have my lenders there, contractors, my entire teams that I use for all of my deals. And you can get the entire network. So you can literally walk away with the know-how, but more importantly, with a plan. So financing won't be a problem. I really won't know it's just taking the time to figure out how to execute at that point. That's it. That's what I want you to be able to walk away with. There's no excuses for how you can proceed. So get your tickets at the strscalesummit.com. I'd love to see you there. And if you enjoyed this episode, be sure to like, subscribe, leave a 5-star review. I'd love that. And I will see you on the next episode of Cashflow Positive.